Drive by any car lot in America right now and you'll see something that should terrify both dealers and consumers: rows and rows of unsold vehicles gathering dust and depreciation by the day. September 2025 inventory numbers are in, and they tell a story dealerships don't want you to hear. Some models are sitting on lots for over 300 days with practically no buyers in sight. Let that sink in. Cars that cost manufacturers billions to design, build, and ship are sitting unwanted across America, some for almost a full year. And the situation is rapidly deteriorating. Jason Miller, a former sales manager at a Volkswagen dealership in Ohio, confirmed what many insiders feared. "I've never seen inventory pile up like this. We're drowning in certain models that nobody wants, even with $15,000 off sticker. The market's completely disconnected from what manufacturers are building." What's happening isn't just a temporary glitch. It's a fundamental shift in the automotive landscape that threatens to upend an industry already struggling with soaring interest rates, inflation, and consumer spending pullback. And if you think this only affects luxury brands or electric vehicles, think again. Family sedans and even some mainstream SUVs are now sitting untouched for months, creating a silent crisis that's about to explode into massive discounts if you know which models to target. But here's what makes this situation truly unprecedented. The vehicles languishing on dealer lots aren't just the obvious candidates like obscure electric cars or overpriced luxury models. Some of the slowest-selling vehicles in America are from brands that once had waiting lists and dealer markups. Models that automotive executives predicted would fly off lots are instead becoming financial anchors, forcing desperate discounting that's creating a hidden opportunity for savvy buyers. What's truly shocking is who's winning and losing in this new reality. Brands that dominated for decades are suddenly finding themselves with unsold inventory piling up faster than they can hide it. Meanwhile, certain manufacturers are selling everything they can build, often at full price or above. I've obtained exclusive industry data showing the day supply figures, how long it would take to sell all current inventory at the current sales pace for every model in America. The numbers reveal a pattern so clear that it's impossible to ignore, yet most consumers have no idea which brands are in free fall and which are thriving. By the end of this video, you'll know exactly which cars dealers can't give away, why they're struggling so badly, and most importantly, how to use this information to potentially save tens of thousands on your next vehicle purchase before this window of opportunity closes. Why are certain vehicles sitting on dealer lots for months while others sell within days? And what does this tell us about the direction of the automotive market in late 2025? The answer lies in a perfect storm of economic pressures, shifting consumer preferences, and catastrophic strategic miscalculations by certain manufacturers that have created the most lopsided automotive market in modern history. Let's start with the hard data. According to exclusive industry inventory figures for September 2025, the 10 slowest-selling vehicles in America have something shocking in common. They're taking between 178 and 321 days to sell. For context, a healthy inventory level is considered 30 to 45 days. Anything above 60 days signals trouble. When vehicles take over 100 days to sell, it indicates a fundamental mismatch between what manufacturers are producing and what consumers actually want. The slowest-selling vehicle in America right now is the Jaguar F-Pace with a staggering 321-day supply. This means at the current sales rate, it would take nearly a full year to sell all the F-Paces currently sitting on dealer lots, if they didn't receive a single additional unit. With 2,673 of these SUVs gathering dust nationwide and only 375 sold in the past 45 days, Jaguar dealers are sitting on approximately $200 million in unsold inventory that nobody seems to want, especially at the average transaction price of $71,000. Coming in second is the Maserati Grecale with a 304-day supply. Despite its prestigious Italian badge, dealers have sold just 106 units in the past month and a half, while 715 sat unsold. At an $81,000 average price point, that's another $58 million in stagnant inventory. The Dodge Hornet takes third place with a 244-day supply, over 3,000 vehicles sitting on lots nationwide with fewer than 700 sold in the past 45 days. This compact SUV was supposed to be Dodge's affordable volume model, but at $35,000, consumers are clearly saying, no thanks. What's particularly telling is the presence of mainstream, relatively affordable models like the Volkswagen Taos on this list. With a 220-day supply and over 19,000 units sitting unsold despite its accessible $30,000 price point, it signals trouble that extends beyond the luxury market. Even more surprising is seeing enthusiast favorites like the Subaru WRX languishing with a 204-day supply. This model has historically enjoyed cult status with a passionate fan base. Yet dealers sold just 673 units in the past 45 days, while over 3,000 sit unsold. Automotive analyst Rebecca Martinez explains what's happening. We're seeing a triple threat of affordability crisis, interest rate pressure, and a fundamental shift in what consumers value in 2025. Manufacturers who built their strategies around cheap money and ever-expanding credit are now facing a market where buyers are far more selective and budget-conscious. The data reveals a stark pattern. European luxury brands and certain domestic manufacturers are struggling the most. 8 of the 10 slowest-selling vehicles come from European brands like Audi, Alfa Romeo, Volkswagen, Maserati, and Jaguar, or American brands owned by European conglomerates. Dodge. Meanwhile, Asian manufacturers seem to be weathering the storm better, with only 2 models, Genesis G80 and Subaru WRX, appearing in the top 10 slowest sellers. This disparity points to a fundamental miscalculation by certain manufacturers about what today's consumers are willing to pay for. Vehicles priced between $55,000 and $80,000 dominate the slowest seller list, precisely the price range that's been hardest hit by interest rate increases and economic uncertainty. When interest rates were at historic lows in the early 20s, a $70,000 vehicle might have seemed attainable with monthly payments spread over 72 or 84 months. In today's higher-rate environment, those same vehicles require substantially larger monthly payments or down payments that many consumers simply can't afford. Former auto industry executive Thomas Wilson explains, many manufacturers set their production schedules and feature content based on the artificially strong demand we saw during the pandemic and immediate post-pandemic period. They committed to building premium vehicles with luxury features at premium price points, only to find that the market fundamentally changed beneath them. This miscalculation isn't just affecting luxury brands. The presence of the Volkswagen Taos and Dodge Hornet, both relatively affordable models by 2025 standards, suggests that even mainstream manufacturers are struggling to connect with budget-conscious consumers. The Hornet, for example, was meant to be an affordable entry point into the Dodge brand, yet dealers have sold just 672 in 45 days, while over 3,000 sit unsold. This suggests problems beyond just price point. Issues of perceived value, competition, or brand positioning that are causing consumers to shop elsewhere. What's particularly notable is what's missing from the slowest seller list: electric vehicles. For years, EVs dominated these rankings as manufacturers produced them faster than consumers were ready to adopt them. Their absence from September's list doesn't necessarily indicate a surge in EV popularity, however. The federal tax credit expiration at the end of September created artificial demand as buyers rushed to purchase before incentives disappeared, explains EV market analyst Michael Chin. We'll likely see EVs return to the slowest seller lists in the coming months as that pulled forward demand dries up. This temporary boost masks a deeper problem for the industry. Massive investments in EV production capacity may soon create even more unsold inventory as incentives vanish and the early adopter market reaches saturation. For consumers, these inventory imbalances create both risks and opportunities. The risks come from buying vehicles that dealers can't sell, potentially leading to accelerated depreciation and negative equity. The opportunities come from the leverage buyers now have when negotiating on these slow-moving models. The situation for dealers and manufacturers is rapidly deteriorating from concerning to potentially catastrophic, particularly for the brands dominating the slowest seller list. When vehicles sit unsold for 6 to 10 months, they generate enormous carrying costs for dealers, floor plan interest, essentially the loan dealers take to keep cars in inventory. Depreciation, insurance, and physical space requirements all add up quickly. These costs eventually force desperate measures that ripple throughout the entire automotive ecosystem. Industry analyst James Wilson calculates the financial burden. A dealership with 50 slow-moving vehicles at an average cost of $60,000 is carrying $3 million in essentially dead inventory. At today's floor plan rates, that's costing them approximately $15,000 to $20,000 per month in interest alone, not counting depreciation or other carrying costs. This financial pressure creates a cascade of negative consequences. First, dealers begin offering increasingly desperate discounts on slow-moving inventory. Models like the Jaguar F-Pace, normally selling near $71,000, are now being advertised with discounts exceeding $20,000 in some markets. When you see 25 to 30% discounts on relatively new models, that's not a sale. It's desperation, explains veteran sales manager Robert Thompson. Dealers are literally willing to sell at or below cost just to convert these albatrosses into cash they can use to stock models that actually sell. These fire sale prices create a secondary problem. They destroy resale values for existing owners. Someone who purchased a Maserati Greco 6 months ago at full price now owns a vehicle worth substantially less than what they paid, often pushing them into negative equity territory where they owe more than the vehicle is worth. For manufacturers, the stakes are even higher. Production plans are set months or years in advance, and factories optimized to build specific models can't quickly pivot to different vehicles. This means the flow of slow-selling models continues even as inventory piles up. Volkswagen's predicament exemplifies this challenge, with over 19,000 Taos models sitting unsold, representing a 220-day supply. Their Puebla, Mexico factory continues producing more units that have nowhere to go. Similar situations exist for Stellantis with the Dodge Hornet and Maserati Greco. The financial impact extends beyond just unsold inventory. Brand perception suffers when vehicles are heavily discounted, creating a perception of desperation and poor value that can take years to overcome. Resale values deteriorate, making leasing programs more expensive to operate as residual values decline, and dealer relations become strained as manufacturers pressure retailers to accept inventory they can't sell. For certain brands, the situation has reached crisis levels. Alfa Romeo, with both its models, Stelvio and Giulia appearing on the slowest seller list, appears particularly vulnerable. With 178 and 184-day supplies respectively, and fewer than 200 units of each model sold nationwide in 45 days, their viability in the American market looks increasingly questionable. Alfa Romeo's position is particularly precarious, notes European auto market specialist Elizabeth Martinez. Their dealer network is selling fewer than 300 vehicles combined per month across the entire United States. That's simply not sustainable for a premium brand with the overhead and infrastructure requirements that entails. Jaguar, with its F-Pace SUV taking the dubious honor of America's slowest-selling vehicle, 321-day supply, faces similar existential questions about its future in the U.S. market. Their decision to take 2025 off as they regroup for an electric future now looks less like a strategic pause and more like a market rejection. Even established brands like Audi, with 2 models in the top 10 slowest sellers, A4 and RS6 Avant, face difficult decisions about their product mix and pricing strategy in a market that's increasingly resistant to their premium positioning. For consumers considering these slow-selling models, the stakes are equally high. The potential savings from these desperate discounts must be weighed against accelerated depreciation and potential future problems with parts, service, and support if manufacturers scale back their presence. James Rodriguez, automotive valuation specialist, warns potential buyers, when you buy a model that dealers can't sell, you're essentially betting against market consensus. Sometimes that works out if you plan to keep the vehicle long-term and don't care about resale value. But if you finance near the full amount and plan to trade in 3 to 4 years, you could find yourself severely underwater. This risk is particularly acute for the luxury models on the slowest seller list. A $20,000 discount on a $70,000 Jaguar F-Pace might seem attractive, but if the vehicle depreciates to $30,000 in 3 years, the initial savings are more than erased by the accelerated value loss. Yet for certain buyers, these market imbalances create once-in-a-decade opportunities to access vehicles that would otherwise be unattainable. The Audi RS6 Avant, with its $152,000 average transaction price and 192-day supply, is now being offered with discounts exceeding $30,000 in some markets, putting this exotic performance wagon within reach of buyers who could never consider it at full price. The key question for both the industry and consumers is whether this inventory crisis represents a temporary imbalance or a fundamental reset of the automotive market. The answer lies in understanding which brands are thriving even as others struggle. What makes this inventory crisis truly fascinating isn't just who's struggling, it's who's thriving despite identical market conditions. And this contrast reveals a fundamental shift in the automotive landscape that's blindsided traditional manufacturers. While European luxury brands and certain American nameplates drown in unsold inventory, other manufacturers are experiencing the opposite problem. They can't build vehicles fast enough to meet demand. Toyota dealers report average inventory levels below 20 days for key models like the RAV4, Camry, and Tacoma, meaning these vehicles are selling almost as quickly as they arrive at dealerships. Hyundai and Kia show similar strength, with models like the Telluride and Palisade maintaining wait lists in some markets despite the challenging economy. This bifurcation reveals the true nature of today's automotive market. It's not that consumers aren't buying cars, they're just being far more selective about which ones they purchase, with priorities dramatically different from what many manufacturers anticipated. The brands struggling with inventory are those that misjudged what 2025 consumers truly value, explains consumer behavior analyst Sarah Johnson. They bet heavily on luxury materials, complex technology, and prestigious badges at premium price points. Meanwhile, the brands succeeding focused on reliability, value retention, and rational pricing. This value shift explains why vehicles like the Genesis G80, with its $69,000 average transaction price, struggle with a 209-day supply, while the more affordable and practical Toyota Camry maintains a sub-20-day inventory level despite operating in the same challenging economic environment. The transformation extends beyond just price point. Data shows that consumers are increasingly prioritizing long-term ownership costs, reliability, fuel economy, and predicted maintenance expenses over prestigious badges or cutting-edge features that may become problematic as vehicles age. This explains why Stellantis brands like Dodge and Maserati appear multiple times on the slowest seller list. Consumer perception surveys indicate growing skepticism about the long-term reliability and value retention of these vehicles, creating reluctance even when dealers offer substantial discounts. Stellantis's challenges stem from what industry analysts describe as a perfect storm of negative factors: aging vehicle platforms, questionable reliability reputations, weak residual values, and pricing that hasn't adjusted quickly enough to changing market conditions. Stellantis invested heavily in extracting maximum profit per vehicle through premium pricing and cost-cutting underneath, explains former auto executive Michael Chen. That strategy worked in a market flush with stimulus money and low interest rates. In today's environment, consumers see through it and are voting with their wallets. Volkswagen's struggles with the Taos, 220-day supply, reflect a different miscalculation, positioning a $30,000 compact SUV in a segment where established competitors offer more compelling value propositions and stronger reliability reputations. The most revealing insight comes from financing data. Vehicles with the slowest turn rates also show the highest dependence on extended loan terms, 72 to 84 months, and the largest gap between manufacturer-suggested retail price and actual transaction prices. This tells us these manufacturers built their business models around financing strategies that no longer work in today's higher interest rate environment, notes auto finance specialist Jessica Martinez. When rates were 2 or 3%, spreading payments over 7 years made expensive vehicles seem affordable. At today's rates, those same payment plans are simply untenable for many buyers. Perhaps most surprising is what's happening with electric vehicles. While they're temporarily absent from the slowest seller list due to tax credit expiration, industry insiders predict a significant inventory buildup in the coming months as incentives disappear and the market returns to natural demand levels. Many manufacturers committed billions to EV production capacity based on optimistic adoption forecasts and government mandates, explains EV market analyst Robert Wilson. Those forecasts assumed continued strong incentives and steadily declining battery costs, neither of which has materialized as expected. This impending E5 inventory bubble could make today's slow-selling conventional vehicles seem minor by comparison. Several manufacturers have EV production capacity that exceeds actual market demand by factors of 3 to 5, setting the stage for potentially unprecedented discounting in 2026. For consumers, this market bifurcation creates both opportunity and peril. The opportunity comes from potentially massive savings on certain models as manufacturers and dealers grow increasingly desperate to move metal. The peril comes from buying into vehicle platforms or brands that may face uncertain futures if their market position continues to deteriorate. The Jaguar F-Pace's 321-day supply represents more than just slow sales. It raises existential questions about Jaguar's entire future in the American market. Similarly, Alfa Romeo's continued struggles, both models on the slowest seller list, suggest the brand's second attempt at establishing itself in the U.S. may be failing just as its first attempt did decades ago. Even established premium brands like Audi face difficult questions about their product strategy and pricing as multiple models languish on dealer lots. The A4's 178-day supply and the RS6's 192-day supply suggest issues that transcend individual model lines and point to broader challenges with the brand's market positioning. Remember those rows of unsold vehicles we talked about at the beginning? Now you know exactly which models are gathering dust the fastest and what it means for you as a consumer in late 2025. The Jaguar F-Pace's 321-day supply isn't just a statistic, it's a flashing neon sign advertising leverage for buyers and distress for dealers. When a vehicle takes nearly a full year to sell at current rates, traditional negotiating rules go out the window. The same applies to the Maserati Grecale, 304 days, Dodge Hornet, 244 days, and every other vehicle on our slowest seller list. These aren't just cars that are slightly underselling expectations, they represent fundamental miscalculations about what today's consumers value and what they're willing to pay. For buyers considering these models, this inventory crisis creates an unprecedented negotiating position. When dealers are sitting on hundreds of days of inventory, their desperation to move units typically trumps any desire to hold out for better prices. Michael Thompson, who purchased a new Volkswagen Taos last month, shared his experience. The online listing showed $5,000 off MSRP, but when I got to the dealership and mentioned I was also considering a Kia Seltos, they immediately offered another $7,000 in discounts. I ended up paying $22,000 for a vehicle with an MSRP of $34,000. They just wanted it gone. However, buyers should approach these deals with clear eyes about the potential downsides. Vehicles with excessive inventory often suffer accelerated depreciation that can erase initial savings within a few years. Models from brands with uncertain futures may face parts and service challenges down the road. If you're buying one of these slow-selling models, you should plan to keep it long-term, advises automotive financial analyst James Wilson. The initial discount may be substantial, but you'll likely take another hit when it comes time to trade or sell. These vehicles make the most sense for buyers who intend to drive them for 7 to 10 years. For the safest approach, focus on slow-selling models from otherwise healthy manufacturers. The Subaru WRX, for instance, comes from a brand with strong overall sales and a committed dealer network, meaning long-term support is likely to remain solid despite its current inventory challenges. Conversely, both Alfa Romeo models, Stelvio and Giulia, on the slowest seller list come from a brand whose entire U.S. future looks increasingly tenuous, creating additional risk beyond just initial depreciation. The most important takeaway is that today's automotive market is no longer one-size-fits-all. While certain models languish for hundreds of days, others sell within weeks or even days of arriving at dealerships. This bifurcation creates both opportunities and risks, depending on which side of the divide you're shopping on. For those willing to consider the slowest selling models, potential savings of 20 to 30% off MSRP are increasingly common. Discounts that would have been unthinkable during the inventory shortages of 2021 and 2022. If you're in the market for a new vehicle, use this information to your advantage. Research day supply figures for models you're considering, which you can find at caredge.com/slowest, and adjust your negotiating strategy accordingly. Vehicles with over 100 days supply should automatically trigger aggressive negotiating, while those under 30 days will likely command prices closer to MSRP. The automotive market of late 2025 offers rare opportunities for informed buyers willing to zig while others zag. The same economic conditions creating hardship for certain manufacturers and dealers create leverage for consumers who understand which models dealers are desperate to move. As we've seen, the 10 slowest-selling vehicles in America now take between 178 and 321 days to sell, creating unprecedented negotiating leverage for buyers willing to consider these models. Whether this situation represents a temporary imbalance or a fundamental market reset remains to be seen, but one thing is clear. For certain vehicles, the power in the dealership has shifted dramatically from seller to buyer. If you found this breakdown valuable, hit the like button to help others find this information. Drop your car buying experiences or questions in the comments below. And if you want to stay ahead of the automotive market's next big shifts, subscribe now for weekly insights that could save you thousands on your next vehicle purchase. This is Auto Truth, bringing you the data dealers don't want you to know. Thanks for watching, and we'll see you in the next video.